financial networks celebrate record corporate profits daily. Yet two major insiders warn the S&P 500 is mathematically positioned for a 75% collapse. Investors often assume stock prices track earnings growth, but corporate profits are only one half of the valuation equation. Wall Street valuations are actually governed by this equation. Stock price equals earnings multiplied by the multiple. The multiple represents the premium investors pay today based on faith in a company's future. In today's market, the average multiple sits at 21. At these levels, 80% of a valuation represents cash flows expected 10 to 20 years out. Shifting demographics and the rapid evolution of AI are now converging to compress that multiple, threatening to erase trillions in market cap, while corporate revenues remain stable. This fragility exists because prices are inflated by future expectations rather than current cash. When those expectations shift, the entire system becomes susceptible to shocks that alter investor psychology. A quick note: this analysis is based on publicly available sources. All content is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence. Chamath Palihapitiya recently highlighted a critical vulnerability in these valuations, rooted in terminal value. This is the financial assumption that market leaders will maintain their competitive moats for 20 to 30 years. Artificial intelligence drives the cost of technological disruption toward zero. Small, agile startups can now use AI agents to challenge entrenched corporate giants almost instantly, bypassing the need for massive research budgets. If AI introduces just a 20% annual probability that a business gets disrupted, the expected lifespan of an S&P 500 giant shrinks to a mere 5 years. Investors refuse to pay a 21 times earnings multiple for a company that might not exist in half a decade. To adjust for that risk, the multiple plummets toward 5 times earnings. We saw this play out between 2016 and 2020. As Amazon dismantled traditional retail models, physical stores didn't vanish overnight, but because their terminal value disappeared, their market multiples were compressed to single digits. The integration of AI into the economy structurally annihilates the long-term terminal value that props up the modern stock market. Curious, deliberate tone. Investor Michael Burry is tracking a second, mechanical force hitting the market. When the S&P 500 is adjusted for inflation and multiple expansion is removed, the stock market's true underlying growth is remarkably flat. The modern bull run is heavily fueled by passive investing. Millions of young workers automatically deposit portions of their paychecks into index funds, providing a continuous flow of capital. That mechanical flow is hitting a demographic cliff. As the baby boomer generation retires, for every one young worker putting money in, 3 retirees now actively withdraw capital. AI-driven unemployment further compounds this threat. As technology replaces labor, it chokes off the incoming capital from the working class that previously sustained the passive investing machine. When net capital flows turn negative, the market physically drains. Without a constant influx of passive cash, valuations revert to historical averages, signaling a potential 77% drop. The combination of a retiring generation and tech-driven job replacement reverses the mechanical force that built the modern market. In a post-compression market, extreme short-termism takes over. Investors will demand immediate, guaranteed cash flow rather than funding 10-year software visions. Warren Buffett is already deploying this defense mechanism. He is currently hoarding nearly $400 billion in cash and short-term treasury bills, waiting out an overvalued cycle. Capital behaves like water. It must flow somewhere. When money flees overvalued, easily disrupted tech companies, it seeks out a secure home. That capital is moving into physical assets that AI cannot replicate or code away: energy infrastructure, farmland, and gold. Surviving the coming decade requires moving capital away from digital moats and back into physical reality. Navigating this macro shift means you can't just blindly deposit cash into index funds anymore. You need to actively monitor market valuation cycles. To track the total market temperature and avoid buying in at peak multiples, search for and download the Buffett Indicator app on the iOS App Store. For advanced research and access to our multi-agent AI deep value intelligence, head over to deepvalues.ai and subscribe. Also, make sure to check out and subscribe to our sister channel at Deep Values, where we cover wider topics on life, philosophy, and wealth preservation. Hit the like button below if you found this breakdown valuable, and we'll see you in the next one.